I am Brandy Whitmire. I am your direct lender, banker, broker, mortgage lender nationwide. We have every product under the sun, can help you out with your purchases, refinances, anything you want. And today I am going to talk about what is an escrow account and do I need one? How does it work? So basically, a few questions that I get. I'm just going to go over some of the basic questions that I get over and over whenever I'm doing a purchase or a refinance. So one of those would be, obviously, what is it? Is it required to escrow? Why did my escrow account go up? Is the lender trying to take me for all I have, or what? Why are they asking for more money? And what does that mean? What happens whenever I purchase a home and the taxes have already been going on for 6 months? What happens at that point? Do I get a credit or do I owe that? What happens to the old account whenever I refinance? Does it transfer over, or can I move it to a new, or what happens to that balance in the other account when I rebuild it? So first of all, I want to talk about what is an escrow account. Okay, so essentially an escrow account is a piggyback account or loan that is on top of your regular loan, your first lien of the home. So it's like a piggyback bank account. It's basically where you can't touch it and the lender can't touch it. So people we can't take from that account in order to pay your principal and interest payment, and you can't go take money out of that account either. It's basically a safe account. It's an escrow account. So that account will hold your taxes and your insurance every month. So it'll be your monthly portion of your payment that you're paying towards taxes and insurance. That goes into the escrow account. So it doesn't go into the fund where your principal and interest goes. So in that account, you will also have 2 months worth of cushion, so that whenever the bills come due, the lender will be able to pay your tax bill when it comes due from the government, from the city, or the county, actually, and we'll be able to pay your insurance when your insurance comes due, which could be any time of the year, depending on whenever you actually purchase the home. If you purchase it in March, it'll be due in March. Your taxes are due anywhere from, it could be in, like here in Dallas, the bills come out on November 1st. In California, we pay them by yearly. So it just depends on that county. Whenever the taxes are due for that county is whenever they're going to get paid out. Okay, so so that account will basically have that, and then plus 2 months cushion. Okay, just in case there is an escrow shortage, just in case those bills went up, there is 2 months worth of cushion in that account for your taxes and your insurance, so that the lender or the servicer, really, wherever you make your payments into, can pay them when they're due. So second question is, what happens if there is an escrow account, and why did that happen? What happens if there's a shortage? So basically, this only happens, the only time you're going to have a shortage is whenever your taxes and your insurance go up. Okay, so that means that literally the lender or the servicer, technically the servicer, got that insurance bill, got that tax bill, paid it, and it was more than that initial projected amount whenever they did the last bill or last refinance or purchase, whenever it was initiated the last time. So the previous time they got that bill or estimate from the county or the insurance, that's now gone up. So that doesn't mean that your lender's not going to pay that. Let's say your insurance goes up $1,000 a year. Your lender's still going to pay that because we've assured you of this escrow account, but it came from somewhere. You have a 2 month shortage in there, or a cushion in there, but we have to make up that shortage, and then we have to get the money back from you. That could be in a lump sum, or it could be monthly, or whatever the case may be. So if the bills go up, it creates an escrow shortage. Okay. Whenever that happens, you can pay one lump sum, or you might, in the beginning of the year, a lot of people, I do a ton of refinances in the beginning of the year. Why? Because, as appraised values go up, guess what? Your taxes go up. Your taxes are based off of your appraised value of the home. So if it's a double-edged sword, right? Like, I don't want my taxes to go up. Okay, well, do you want your value to go up? Yes. So when your value goes up, the taxes go up, right? And the county value is not typically what your actual appraised value is going to be. It's just going to be a county assessment, thankfully, right? Because some of these, places are appraising so high. If you were actually paying taxes and what your appraised value would be, you'd be really mad. So, so when that happens, again, we've got to get that money back from you. So again, I do refinances a lot in the beginning of the year because whenever you refinance, you can rebuild your escrow account to rebuild the escrow account to get your 2 months cushion back and get the bill ready basically for the next time. This especially happens in new builds because whenever you're building a home, typically that land value or the new improved value is going to be a lot lower. So let's say you're building a home and we assess taxes on $200,000, and we got the appraisal, or the county went back and said, hey, all these homes went built up all around you, and now the house is actually worth $250 according to that, but we did an appraisal and it was for $300. Whatever the case may be, that's going to make your tax bill jump up quite high, right? So anyway, a way to get that taken care of is pay it one lump sum, pay it in your monthly payments, or refinance and get the whole thing back rebuilt and see if there's any benefit there. Okay, so sometimes, what if there's a surplus in my account, right? What if I actually got with my insurance company and they were charging me $2,000, and I went to another insurance company and they're only charging me $1,000 a year? What happens to the extra $1,000 for the year? Well, they will cut you a check. So the lender or the servicer will cut you a check for a surplus as long as it's over $50. Okay, if it's less than $50, then it's going to be applied to that next year. So anything over $50, the lender, the servicer cannot keep that money. It has to be refunded back to you immediately. Okay, and another question is, do I have to escrow? This is a big question. A lot of people don't want to escrow, especially my investors out there, because they want to put all of their money that they can into another investment, or an interest-bearing account, or whatever the case may be. Their financial advisor wants to keep as much money in their accounts or whatever. So anyway, do I have to escrow? So the answer is this: if it's a government-insured loan, which means it's a VA loan, an FHA loan, or a USDA loan, then yes, absolutely, you always have to escrow. No matter what, there's no ifs, ands, or buts. You have to escrow your taxes and insurance. However, on a conventional loan, as long as your first lien is at 80%, you do not have to escrow. Okay, so why am I saying the first lien at 80%? So let's say you are buying a home for $100,000, okay, and you take out a 95% loan, which means you're taking out a $95,000 loan. Well, that's going to be over 80%. So yes, you must escrow your taxes and insurance because your first lien is over 80% loan to value. However, on conventional loans, you can take 2 liens out. So you could take, on that same instance, you could take that $100,000 purchase price. You could do one loan for $80,000, and you could do the second loan for $15,000. So altogether, that's going to be $95,000. In that case, you do not have to escrow. And by the way, you won't have mortgage insurance, because as long as that first lien is at 80%, you're not required to escrow, and you avoid mortgage insurance. Now that second lien might be a higher rate, whatever the case may be, but you want to look at that. But most often, it's going to be better for you if you don't want to escrow, especially, or if you don't want to pay mortgage insurance, to do a conventional loan, first lien at 80% and the second lien at the additional whatever you're at. 80, if you're doing a 95%, 85%, 80, or 90%, doesn't matter. So the way to avoid that is to actually cut that down to 2 loans, and that way you can avoid it. Okay, so what happens to an escrow account whenever I am purchasing a home? So let's say you're purchasing a home in June, and your lender sends you a closing estimate, and it shows that you owe 6 months worth of taxes plus 2 months cushion. You're looking at it like, hey, wait a minute, why am I paying 8 months? Well, you're not. So we have to have enough money in there to pay your bill when it's due. So we have to collect from you the 6 months plus 2 months cushion, so that's 8 months. However, on that closing disclosure, you're going to see an aggregate amount from the seller. So the seller has to pay for the taxes for the time that they lived in that home. Okay, so you're going to see a credit from the seller for the taxes for those 6 months. Then you're paying that 2 month cushion plus probably one more, because you are paying one month into arrears. So technically you'd have 9 months on that, but you are not paying that 9 months, but it has to go in your account because we have to pay them when they're due. Now on insurance, you're starting that right away. So again, let's talk about June. So in June, you are paying 1 month upfront in your insurance plus 2 months cushion. So you're going to have 14 months of insurance in there. So your insurance starts on the month that you actually purchase the home. Okay. Same thing on a refinance. What happens on a refinance? So on a refinance, oftentimes they'll say, okay, hey, can I transfer my escrow account? I have 3,000 in my other escrow account. What happens to that? Okay. If you're working with the same lender, like for example, if you have a loan with me and I'm servicing your loan, and we can transfer that. It's called netting the escrows. We can transfer that to the new account. Most often, that's probably not going to happen. It just depends, because it just depends. You might be able to. However, in the case that you're not on the new account, you're obviously rebuilding that escrow account. So you're getting enough taxes and insurance in that account to pay the tax and insurance amount when they're due, plus the 2 months cushion. Okay. The previous account that you had on the other loan, that is refunded to you within 30 days of closing. So you will get that check back in the mail. And when you get that check back, I just had a friend that called me and said, hey, I got a $2,600 check back. What do I do with it? Do I owe? Like, she was freaking out. She was thinking that we didn't collect the amount of money and whatever. And I'm like, no, you deposit that. You need to deposit that $2,600 into your bank account and do whatever you want with it. Pay down your mortgage, go on a trip, pay off high interest debt, do whatever you want with it. That check is yours to do whatever you want to do. Okay. Now on the refinance, so you can, since it's kind of you're taking this account, you're rebuilding it, and you're getting that. So you can bring that to closing if you want to, because you are deferring a payment or two. Okay. You can roll it into the account. And sometimes you can pay for that account with your interest rate. If you choose a higher rate with a lender credit, you might be able to pay those taxes and insurance with the interest rate. You just need to call us and let us see if that's available to you. Oftentimes that's what I do, so I can make a little bit more money and manipulate the money a little bit more. So anyway, that is a lot about an escrow account. However, it's a question that we get a ton. And it's really important to understand, because it scares a lot of people away, because those numbers can get really high, especially if you have a $4,000 tax bill. Sometimes I have people that have $25,000 property tax bills. I have people who have $5,000 insurance bills per month. So great question, Shelly. What about flood insurance? Flood insurance is directed by FEMA. Okay. Flood insurance is over and above hazard insurance. So we collect hazard insurance in your escrow account. However, we don't collect the flood insurance. The flood insurance has to be paid directly to FEMA. That's a government charge paid directly to FEMA. However, I do believe in Shelly, in some cases now, are we able to escrow the flood insurance? I believe that we can in some cases now. I think we have a product actually right now that's actually making us now escrow the flood insurance because of some of the hurricanes and things that have been happening. But we'd have to look at that county and that actual product. So it just depends on the product and things like that. But great question, Shelly. And we do get that a lot as well, especially in our coastal states like Florida, Louisiana, Alabama, and California. Yes, always escrowed out, and that again is a FEMA charge, and always and not based off of anything from the lender. And that's something important to know too. The lender does not tell you what your taxes are, what your insurance are, what your flood insurance are. The taxes come directly from the county. The insurance comes directly from your insurance company, and the flood insurance comes directly from FEMA. So that is, again, that's a lot about an escrow account, but it's very important because it scares a lot of people away, like I said. But if you have any other questions on escrow accounts, which is such an amazing and interesting topic, obviously, but if you have any other questions on escrow accounts, how it works, and if you need it, and how you can manipulate it, also there's ways, then reach out to us. You can email me, bwhitmire@financebyhome.com. You can call us at 214-660-5000. You can go to our website, brandywhitmire.com. You can send a pigeon. You can do whatever you want. Just reach out to us any way that you can. We would love to help you on your refinance. See if there's a benefit for you. See if you can reduce your rate, your term, help you make some money on it. And absolutely work on your next purchase, your second home, vacation home, or your next investment. So thank you very much for tuning in. I hope this was helpful and informative. Let me know if there's any other topics that you want to discuss. And I will be with you next time, next week at 6 o'clock. Hope to talk to you soon.